The stock market is currently closed. As of the final bell on June 17, 2026 at 4 p.m. EDT, BigBear.ai Holdings Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, finished the regular trading session at a price of $3.88 per share. This represents a noticeable dip from its recent local peak near $5.34 at the start of June, leaving retail investors and institutional funds scrambling to reevaluate where this micro-cap artificial intelligence player stands in a broader tech ecosystem that remains fiercely volatile. While mainstream traders look at this sub-$4 valuation and immediately see a struggling enterprise on the verge of breakdown, the underlying institutional movement tells a vastly different story that almost nobody is discussing openly. Behind the scenes, major algorithmic trading pools and sovereign-adjacent data platforms are quietly tracking the company's recent authorization to double its common stock capacity from 500 million to 1 billion shares, a corporate change voted through at the annual meeting on June 9, 2026. This sudden expansion of available equity has created massive short-term selling pressure, but it simultaneously provides the raw capital fuel needed to execute a growing backlog of defense and intelligence contracts that most small-scale portfolios completely overlook. The common expectation surrounding small-cap defense AI companies is that they are speculative shells, riding the coattails of giants like Nvidia stock, waiting to be crushed by larger conglomerates or diluted into oblivion. Retail speculators logging into a retail fidelity trading platform or browsing popular investing sites often assume that any asset trading beneath $5 is an automatic trap. The reality, however, is that this market sector does not operate on retail hype. It runs on deep-pocketed government procurement cycles. While a typical investor using a basic individual brokerage account looks at a net loss in a single quarter and panics, sophisticated financial institutions utilize interactive brokers platform setups to analyze non-cash items, such as the massive settlement of $124 million in convertible notes that occurred earlier this year in January. By cleaning up that legacy debt, the company eliminated a heavy interest burden, fundamentally improving its balance sheet posture even as the headline stock price wavers. This contrast between superficial market anxiety and core corporate restructuring forms the exact pocket of mispricing where experienced market participants seek opportunity. When you look at how people manage their self-investing decisions today, whether they are allocating funds through automated channels like Schwab Intelligent Portfolios or picking individual equities on the Robinhood app, there is a tendency to treat all artificial intelligence plays as if they belong in the same basket. People see the spectacular climbs of large tech firms but expect every small company building machine learning models to replicate that exact path. But software engineering for consumer applications is completely distinct from data intelligence built for national security. BigBear.ai has historically suffered from uneven, lumpy revenue streams, precisely because it relies heavily on massive military and federal clients, such as its recent $53 million classified intelligence contract and over $60 million in national security wins recorded during the first quarter of 2026. This makes its financial reporting look erratic compared to standard software-as-a-service businesses. When the company reported a slight 1% revenue decrease to $34.4 million for the opening quarter of the year, superficial scanners on common Robinhood stock trading feeds immediately initiated sell orders, completely missing a massive expanding gross margin that leaped from 21% up to 34% due to higher margin software product mixtures. To understand the current volatility surrounding this asset, we have to inspect the massive trading volumes and institutional positioning occurring across major networks like Fidelity Investments and Interactive Brokers stock trading pools. Throughout June 2026, the daily trading volume has routinely crossed 25 million shares, indicating intense distribution and accumulation cycles as large funds adjust to the newly authorized share structure. When a company doubles its authorized share cap, the immediate expectation is severe dilution, which naturally dampens short-term sentiment on active SoFi investing message boards and standard individual brokerage tracking tools. Yet the leadership team managed to reaffirm their full-year revenue guidance of $135 million to $165 million, a sign that the expanded equity capacity is designed for strategic maneuvering rather than emergency survival. For individuals executing an online investment strategy, determining whether this capital expansion will be used for accretive acquisitions like their recent absorption of the AskSage platform, or if it will simply wash away existing equity value is the central question driving the current tape action. Let's pause right here because I want to hear your perspective on how these small defense tech plays fit into your personal strategy. Comment below how many shares of BigBear.ai you currently hold in your portfolio, or if you prefer sticking to large cap tech companies instead. Looking closer at the microscale data, the integration of the AskSage platform has altered the financial profile of the business in ways that standard robo-advisors or automated intelligent portfolio systems cannot easily contextualize without human analysis. AskSage brings a high-margin generative intelligence architecture that has actively cushioned the drop in traditional Army program volumes. This structural shift explains why the gross profit expanded even as top-line revenue looked flat on the headline reports.
When investors leverage specialized tools like the Fidelity mobile app to dig into the quarterly files, they can see that total available cash and investment stood at a robust $431.5 million at the close of the spring quarter. This provides a substantial liquidity runway that shields the operation from immediate credit crunches, a fact that is rarely highlighted on mainstream online investing platforms that focus exclusively on basic price-to-earnings metrics. The market has priced the stock as if it faces imminent distress, yet its cash position relative to its overall market valuation suggests a much more resilient financial foundation. To put this into a broader investment perspective, consider how retail capital behaves across different trading vehicles. A user managing a Robinhood cash management account or setting up long-term retirement security through Fidelity IRAs will look for stability, steady cash flows, and predictable growth. They might allocate their capital toward broader sector instruments like Fidelity ETFs, SoFi ETFs, or high-performing megacaps like Apple stock or Tesla stock. Those choices are anchored in mature business models with global consumer brand loyalty. On the opposite end of the spectrum, an active trader using sophisticated interactive brokers trading systems is hunting for severe discrepancies between corporate valuation and forward contract backlogs. BigBear.ai fits squarely into this aggressive, asymmetric risk profile. Its valuation is tightly bound to its capability to clear its growing backlog and translate federal trust into repeatable commercial sales with complex logistics, trade, and travel sectors. The operational footprint spans across automated shipyard intelligence systems and critical international supply chain tracking, which are areas completely decoupled from traditional consumer tech spending trends. If we look back at the older reports and past performance data to establish common ground, the company entered the public markets via a blank check merger during the peak of the speculative blank check boom, hitting an all-time closing high of $12.69 back in April of 2022. That initial spike was driven entirely by macro liquidity and generalized excitement around data intelligence rather than sustainable operational metrics. What followed was a multi-year reality check where the organization had to face the grueling reality of long government sales cycles, high research and development expenses, and sticky selling and administrative overhead. For instance, the general and administrative expenses rose by $6.5 million in the early part of this year, which dragged down the adjusted EBITDA into negative territory. This historical pattern of high spending is exactly why many long-term observers using conservative investing sites remain highly skeptical. They see a legacy of persistent net losses and fear that the company will continually rely on issuing pieces of its authorized 1 billion share pool to keep things running, leaving retail holders with a smaller piece of the pie. However, the structural landscape of modern defense spending is undergoing a massive shift that directly impacts how these platforms are valued by institutional allocators. Modern defense infrastructure requires highly adaptable predictive analytics to decipher complex telemetry, coordinate sovereign border security, and optimize global military asset deployments. The legacy software giants often struggle to provide the nimble, specialized codebases required for these hyper-specific federal missions. BigBear.ai has positioned itself as an agile intermediary, capable of deploying decision intelligence tools rapidly across multiple branches of national security. When you analyze the asset through a premium setup like interactive brokers fee schedules or deep-tier Fidelity wealth management data, you recognize that the company's real worth is tied to its security clearances and hard-coded integrations into federal networks. These relationships take years to cultivate and establish a defensive moat that cannot be easily replicated by a new software startup, regardless of how much venture capital that startup raises. Looking forward, the future outlook for this stock relies on a fine balance between contract execution and share dilution management. In a positive outcome scenario, the company successfully converts its 14% sequential backlog increase into recognized high-margin revenue over the next few quarters, meeting or exceeding the upper limit of their $165 million annual guidance. If they can achieve this while keeping their newly authorized shares tightly controlled, the market will likely reward the stock with a valuation multiple closer to its peers in the enterprise intelligence space, which frequently trade at significant premiums on mainstream SoFi stocks trackers. Conversely, the risk scenario involves the company aggressively tapping into that expanded share pool to fund extended corporate operations or to overpay for secondary software acquisitions. If the market witnesses a steady rise in the outstanding share count without a corresponding explosive growth in quarterly cash flow, the stock could remain suppressed under $4 indefinitely, trapping impatient capital that entered looking for a quick tech pop. Ultimately, evaluating an investment of this nature requires an understanding of the deep divide between short-term market narrative and long-term corporate execution. Retail investors using standard SoFi active investing options or basic automated SoFi robo-advisor systems are often looking for instant price validation, tracking every minor intraday tick on a mobile screen. But real enterprise turnaround stories in the institutional data sector require patience, as they are governed by federal budget allocations and complex contract awards rather than viral social media trends. BigBear.ai has cleared out its major balance sheet debt, secured a robust baseline of cash, and obtained the corporate flexibility to expand its capital base when necessary. The market's immediate expectation is that the share expansion will destroy value, creating a cloud of pessimism around the 3.88 closing price. The reality is that this newly created operational flexibility might be the exact tool required to scale their software products across a much wider array of commercial and federal ecosystems. As the market moves forward through the summer of 2026, the true test for the company will be showing the street that they can turn their massive backlogs into real sustainable profitability. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.